Welcome to this essential guide on mastering two of the most critical concepts in technical analysis: support and resistance, and the indispensable risk-reward ratio. These are the cornerstones of profitable trading. We are focusing on price action trading, which fundamentally relies on interpreting past price movements to forecast future market behavior. Understanding where price has reacted before is your first step. Let's begin by defining support and resistance, often abbreviated as S and R. These are specific price levels that historically cause price to pause or reverse direction. S and R levels are critical because they define where traders are likely to enter or exit trades, providing clear points for trade planning and risk management. A support level is a price point where buying interest is strong enough to overcome selling pressure, typically leading to a bounce. Think of it as the floor for the price. Visually, support is identified by multiple price low points clustering around a horizontal area on your TradingView chart. The more touches, the stronger the support. Observe how the price approaches this support zone and then reverses. This bounce demonstrates that demand increased significantly at this specific level, stopping the downward movement. Conversely, a resistance level is a price point where selling interest outweighs buying pressure, acting as a quote ceiling where price struggles to move higher. Resistance is visually identified by horizontal areas where price has peaked or reversed downwards multiple times. This area indicates significant supply is entering the market. Notice the reaction here. As the price hits the resistance, it is rejected by sellers. This rejection confirms the resistance level as a strong zone of supply. When marking S and R, it's often better to draw zones rather than single lines. A zone accounts for minor price fluctuations and ensures a more flexible approach. Use the horizontal line or zone tool on your TradingView platform. Look at higher time frames like the daily chart, as these S and R levels carry more significance than lower time frame. A key concept is the flipping of S and R. Once resistance is broken, it often becomes the new support, and vice versa. This indicates a shift in market psychology and momentum. Now let's shift our focus to risk-reward ratio, or RR. This is perhaps the most crucial element of successful trading psychology and capital management. Risk is the maximum you are willing to lose, defined by your stop loss. Reward is the profit target, defined by your take profit. The ratio compares these two distances. The RR ratio dictates your long-term profitability, even if you don't win every trade. A good RR means your winning trades cover your losing ones, keeping you in the game. To apply RR, first measure the distance from your entry to your stop-loss risk, and then measure the distance from your entry to your take-profit reward. Use the RR tool on TradingView to visually set your stop-loss below your entry for a long trade and your take-profit higher. The ratio will be automatically calculated. Aim for a minimum risk-reward ratio of 1 to 2. This means for every $1 you risk, you aim to gain at least $2. This ratio allows you to maintain profitability even if you only win 40% of your trades. The true power comes from integrating S and R with RR. Support and resistance levels provide the precise boundaries to define both your risk and reward. For instance, entering a long trade at a strong support level, placing your stop loss just below that support, and setting your take profit at the next resistance level. This defines a clear, favorable RR trade setup. Remember to practice finding clear S and R zones and calculating RR on your TradingView charts. Consistent application of these two concepts is key to improving your trading results. Thank you for watching.